Example of something else that's kind of public like that to, I guess, download yourself. Um, it's kind of hard to think of other public technologies that you can just download. But yeah, that's it's just the nature of the protocol.
Can you give an example of what sharing what sharing it is? What are we sharing here? The information of what your transactions are?
Correct. So the question is, what are we sharing? So yes, all of the information that is shared between any user on the network is all transactions.
So anything that I go to use to purchase with that, everybody knows that I did that.
Correct. Yep, they do. Except you do have some anonymity, of course. Like in this block, the most current block, obviously I can't tell who is who in this list because all of these are just Bitcoin addresses. But we are all just transacting on this public ledger. So it's like if you were able to download your entire bank's history of their ledger between every single account holder, except you don't have a social security number tied to that information or your identity. You can tie it to your identity, but you can choose not to. Yeah, so that's probably the best way to describe it. It's just, it's just a financial ledger that anybody can see and download.
What would anybody use that for?
Anybody, the original that people are using, it's just your version of it at home.
Say that question again.
When it said anyone can download and maintain, you mean just you download to your version on your computer at home. You're not affecting the actual version online.
No, the version I have is the one that is shared across every single version of every computer running it. It's just in the case that Bitcoin is decided to be something else, I am still running a previous version of Bitcoin. So for an example, I guess the greatest example of this is in 2018, Bitcoin Cash was created as a fork off of Bitcoin. Anybody that was able to hold and maintain their own ledger was able to decide which direction they wanted to go. Did they want to stay with Bitcoin or did they want to go with Bitcoin Cash? And then they decided that. So as soon as you switch all of that technology or you keep Bitcoin's technology as it is, you decide, you have a vote, you can maintain your worth of what Bitcoin you own based on your data entries or that copy of the ledger that you have, because it is a true copy of the actual ledger. If that makes sense. And then June, you were asking what would that be used for?
Mm-hmm.
Yeah, so it's basically to keep track yourself that, for an example, somebody cannot tell me that I didn't transact X or didn't transact this transaction that I sent to Alice or Bob, right? Because I have a true copy of the ledger, but then another person in the world also has that true copy of the ledger. And in the case that a malicious user tries to say that I didn't transact that, well, the true copy of the ledger is protected by proof of work, for one thing, but two, it's just distributed among thousands of people to be able to keep that true data. And this is what we had talked about of the solving of the Byzantine generals problem, which I'll talk a little more about today, because today is going to be more of a summary of everything that we've gone over, but also a reason why I believe out of everything, Bitcoin is the one thing that will win. But yeah, I think it's just hard to explain why it's important. But if you hold your own copy of that ledger, nobody else can tell you what your Bitcoin is or isn't, because you have that own copy, and you have a vote in the system for what Bitcoin actually is.
So it will help fraud and that kind of thing then?
Yes, it could. For an example, because you are able to have your own, let's just say that you weren't able to have your own, then you're trusting a centralized entity to
Okay.
save all that data, right? However, in the case of what we see in our traditional finance system, where say Equifax, right, probably one of the largest breaches we've ever seen in terms of financial data be stolen and just United States citizens' data in 2018, Equifax holds all of that data themselves, and one, they can manipulate any of the data. This isn't on a blockchain or anything, but a hacker can easily hit that one central person, right, instead of coercing thousands. Yes.
So how do you keep your own ledger?
Sure.
Your own download?
Yeah, so,
Because I assume it changes.
right.
You can change it continuously.
Yep, so you can keep your own version of it by, well, it depends on what you want to run it on, really. For an example, like I have this laptop right here. I can run Bitcoin on this laptop, and as long as I have the storage to hold the blockchain, I can hold it on this laptop. And every time I connect to the internet, it'll download the True Ledger.
So what it'll do is it
Correct.
It rewrites the file, you know.
Oh yeah, it just continually adds
Not
on.
exponential that way. I keep thinking like PDFs.
Yeah.
They just kind of stack up. and-
Yeah, I mean, in a way, it is similar to that. It's just,
But, I mean, ultimately, I know Josh here, in storage ability.
Mhm.
If it was just like, you know, if you still had yesterday's version, I guess, and nothing would be easy to keep. So at the same time, though, people would have access to knowing how many Bitcoin you have.
if they knew all of your addresses, or rather, if they knew your private key. But-
So the public, all those public transactions don't include like balance.
They do, they
All
do.
transactions?
Yes, every transaction has a balance associated with it. However, nobody knows like that you sent that or whatever. For an example, like if I sent you Bitcoin right now, there's no way of anybody else in this room knowing, just between us two, what our Bitcoin address is that we sent each other.
Oh, so there's not a name attached?
No, not at all.
To the data?
Correct. There's no identity attached to Bitcoin in any way. The only reason identity gets attached to Bitcoin is because of people that buy Bitcoin through exchanges that have identity attached to them. Because to link a U.S. bank account to an exchange to then buy Bitcoin, you have a social security number attached to that. Otherwise, you can get it. You can get Bitcoin in many other ways, which was kind of what we had talked about at the end of the last lecture, and I know we kind of went over time and whatnot, but yes, you can get Bitcoin in many other ways completely anonymously. And one of the best websites I've found for that is called localbitcoins.com. Just trying to.
Well, when you talk about one of the values of Bitcoin is transparency,
Yes.
to me, you just described a situation that's not transparent. What am I missing?
So it's transparent in terms of everybody in the world can see that transaction happen, right? There's nobody that can hide that transaction happening.
Well, what difference does it make if they don't know the source of it?
Because there's no fraud on the network. Because if nobody can see the transparency of the ledger itself, then you can't know if there's 21 million Bitcoin or not. You get what I'm saying? However, because it's public, everybody can verifiably see that every single Bitcoin transacted, all added up together, will add up to the current amount of Bitcoin that is in circulation or being held in wallets.
Oh, so it's,
Yeah, so that you know that nobody's committing fraud. Now, you can commit fraud or theft in, of course, schemes of like, oh yeah, for an example, ransomware attacks are a great example. Like people threaten people with sending them Bitcoin if they lock your computer up completely, right? And that's just one, that's the reality of kind of the world of technology where we're in. I mean, you're relying on abstract security of your own computer to then be threatened with ransom. And a lot of times I've seen that Bitcoin is used for ransom, and I don't really understand why, because being a public ledger, it can be tracked. So, like if you report that address to the FBI, which actually just this past week, the FBI caught a hacker from 2012 on the Silk Road that stole over 50,000 Bitcoin, but was able to track from the original address that he had, was able to track exactly who he was eventually because he messed up eventually, just because he had tied his privacy to one of the addresses, and it just so happened they found that. Now, when the government caught him, they actually couldn't get the Bitcoin until they basically just threatened him, and he gave up the private key for it. But yeah, it's just like that. That's the reality of at least having a public ledger, is that to do crime on it, you can still be caught. There's no doubt about that. But then again, because it's transparent, it has, well, one, it gives it probably the best security out of any financial system in the world. Because imagine somebody hacked the Federal Reserve and just wiped out all debt in the world, which is the premise of a show called Mr. Robot, and that I highly recommend that as a show. It's a cool show. But yeah, it's just the reality of centralizing security or decentralizing it, right? So, yes, question.
The ledger file that you have a copy of, everybody can have a copy of it.
Yep.
When it updates, you log in, it updates. It just appends the new transactions. It doesn't bring the whole file out.
Yes, so the ledger file, it's not just one file. It's a database that's split up into many files, but it can be added on to. But yes, it is just dependent on as transactions come in.
And how big is that collection?
Yes, correct. So we talked about this a little bit 2 weeks ago. Bitcoin's blocks themselves, each block can only theoretically be up to 4 megabytes. Most of the time it averages less than 2 megabytes. So every roughly 10 minutes, it's no exact time, around every 10 minutes, 2 megabytes are added on to the chain. And currently now the Bitcoin blockchain is roughly, I think, 440 gigabytes over 13 years. So you can expect another 13 years, it'll be 880 gigabytes. So it'll reach, within 30 years, probably a terabyte of data, which is pretty feasible today. And as Moore's Law continues on and technology gets better exponentially over time, storage becomes a lot easier as well and cheaper. Yeah. Then I did have another question before we get started in this presentation. I don't mind. I don't mind if questions are given throughout the presentation or not. But okay, so there was a person that asked what causes the fluctuation in the value of Bitcoin. I was looking at it as a stock, but it is a currency, correct? So a lot of the value volatility comes from just what people believe it's worth in the free market. And currently right now, according to this week, a lot of that price volatility has gone haywire because of a default in the second largest exchange in the world. So a lot of Bitcoin has actually come back onto the market. So I'll explain that real quick, just so that you'll have a basis of understanding at least what happened this past week. So FTX is a crypto exchange, meaning they can trade, you can buy and sell crypto on that exchange through the regulated FTX US in the United States or the international one, FTX.com. And they have been thought of as this mastermind, insane crypto exchange company since their inception in 2019, roughly. So they've only been around 3 years. And so going back a little history, Binance is the top crypto exchange in the world. And they were formed in 2017 by their CEO, now CZ. And so CZ and the founder of FTX, I'll just name him Sam. CZ and Sam have had this interesting relationship because Binance being the top exchange in the world, and then FTX coming up as this this amazing exchange, there was competition there. So CZ runs Binance out of, I believe it's Hong Kong, but it's an international exchange. It doesn't adhere to regulations like FTX would in the United States. However, Sam has been, over the past few years, been trying to leverage United States politics to also gain a competitive advantage in crypto exchanges in the world. And we know this because Sam himself eventually becoming a multi-billionaire, like roughly, I think he topped out at like $15 billion. He was the second largest donator to the Biden campaign in 2020. So one, he definitely has a good relationship with a lot of politicians and regulators in the space, and has been trying to just gain that competitive advantage, like I said. So FTX overall has been running as this very popular exchange. I mean, we've seen Super Bowl commercials for them. We've seen many celebrities endorse them or make deals with them, partnerships, whatnot. Most notably, Tom Brady is probably the biggest one, and he wrapped up around $650 million in FTX. And FTX themselves, I believe, we're talking 20, 30, possibly $30+ billion that was in this exchange. So, what happened this past week? Last week, there was a CoinDesk article that, with leaked information, reported that FTX's partner, Alameda, Alameda is their trading partner and their money market maker. So they make a lot of the trading decisions and everything for FTX, and then FTX itself is just the exchange. However, Alameda, from our understanding right now, none of this has been really too much released publicly, but there's a lot of good data to back this up. Alameda held and was reported holding a lot of FTX's token for their exchange, called FTT, as their reserve asset, and they, like, on their balance sheet. So Alameda used FTT as collateral against loans that they took out, and this was leaked information literally just last week, and it was in the billions of dollars as collateral. So what happened is that I believe CZ and then Sam basically had this falling out of where CZ didn't really trust Sam anymore. But going back in 2017, like I said, Binance became the largest exchange in the world. In 2019, Binance invested in FTX as one of the primary stakeholders and then received the FTT token in return for their investment. And they held a decent amount of FTT. I think it was roughly $500 million, estimated when FTT was at $22 exchange rate. So anyway, so CZ went on Twitter, like this was, I think, Monday or Sunday, just this weekend, and said that he would be liquidating all of his FTT positions on their balance sheet because he now no longer trusts Sam, and basically just getting rid of any relationship with FTX as a partner. So Binance, being the #1 crypto exchange, and then having the second largest crypto exchange as their competitor, this was an interesting thing that was happening, because if CZ dumps FTT onto the market based on supply and demand, that makes FTT's price drop significantly. But he mainly stirred up through just a tweet. He caused a bank run on FTX. So everybody that was involved with FTX, in one day, yesterday, in one day, $7 billion was transacted out of FTX. So in just one day, we saw a complete selling of FTT's token by Binance, then a bank run on FTX, where they then halted withdrawals yesterday morning, and then due to them needing to pay with their partner Alameda, them needing to pay the loans back because the FTT collateral now is a lot less, so it actually couldn't pay for the loans. They basically went insolvent. They defaulted, and yesterday morning it was announced that Binance would be buying, in a non-binding agreement, buying FTX.com. So CZ just played this master game of chess where he basically just took out the competition just like that, by one being an original stakeholder and then using that as his advantage over FTX once relations got a little in the bad water. But however, today it's come out as more news. Now the SEC, CFTC are looking into FTX now because they believe that they were illegally lending money and doing other things, possibly committing fraud with consumers' money with the exchange and then Alameda themselves. But then Binance, through a leaked report from the Wall Street Journal, is likely going to back out of the entire agreement because it's non-binding, so they're allowed to do it. And it's because Binance has looked at kind of what got them into this hot water, and they're basically saying that there's no way to save them. So it also came out today that Binance would only do the agreement if they were allowed to buy FTX.com and FTX US, so take over the entire company. So because of this, all this stuff happening, a bank run, a lot of devaluation in some of the things, fear in the markets, we saw basically the second largest crypto exchange in the world just go completely bankrupt in a matter of 2 days. And this, because of this and them going bankrupt, they need to somehow come up with the capital to then pay off their loans. So they've been selling their balance sheet, which contains all of these other cryptocurrencies, Bitcoin, Solana, Cardano, all these other ones, Ethereum. And this is what we've been seeing, why the price has been tanking. Now, I will not say that like it can't go any lower or anything, because I mean I've kind of expected this to happen at some point, but it all goes to show that you should never trust an exchange overall. And this has been a lesson that's been learned many times in the past 13 years. But it's just there's people that keep continuing to keep their money on these exchanges, and it's crazy because Sam was hyped up to be this next Berkshire Hathaway type of company, and by Forbes and all these places, and the infamous Jim Cramer has said it was a fabulous company, like top tier investment company, and even Sam himself had said that many companies would go insolvent, or many exchanges would go insolvent over the next year, and I guess he didn't see that in his own company. So
How's Robinhood affected by this?
how's Robinhood?
Yeah, they're in this news too.
Yeah, well, probably because they've gotten involved with crypto over the past. Well, Robinhood's been in hot water since 2020, but personally, I've never liked Robinhood really.
Anyway, they're involved in something.
Yeah,
They're
yeah,
something.
they-
It's affecting them too.
Yes, because of all the fear in the markets going on, likely it's mainly what's happening is for Robinhood's sake. What they do, they don't allow you to actually buy the cryptocurrency yourself. They just buy the paper certificate for the crypto.
They're really liable.
Oh yeah, right. And so what they do, I'm guessing, and I've seen this happen plenty of times, whenever they have a large amount of volume that is trying to be withdrawn, they just suspend all trading. So due to that, not only Robinhood, but Crypto.com has been affected, Coinbase has been affected. A lot of these exchanges, I assume people are just trying to get money off of them right now.
Grayscale, an exchange?
Grayscale is not an exchange. They are just an investment firm.
Okay.
Yeah, but they hold a ton of Bitcoin themselves, and they're the same thing, except they do it through an ETF where people can have a paper certificate for the Bitcoin ETF. But they buy spot Bitcoin. They don't buy futures Bitcoin or anything. So yeah, that's everything that happened this week. Yes, question.
I had some difficulty following the thread.
Sure.
So Binance was originally going to take over the failing
Yes,
exchange.
correct.
The single tweet, did they have anything to do with it?
Binance? Oh yeah, the CEO of Binance tweeted it.
Okay, that's what I thought.
Yeah.
And
Yep.
I thought it was the CEO of FTX.
No. The CEO of Binance said he would be
So,
liquidating all
He
FTT.
knew
Oh,
that
alright.
he knew
Yep.
that he was going to be causing this chaos.
Oh yeah,
So it
yeah.
was
Everybody
so
knew it.
Just looking to get a fire sale.
Yeah, well, in a way, yeah.
Breaking-
Yeah.
That sounds to me like it's totally illegal.
Oh, well, see, that's the thing. In a way, it would be, but the crypto markets are completely like a free market. So, yeah, there's really no
One
regulation.
individual can still, entirely disrupt.
Mm-hmm.
So the value of Bitcoin was brought down by this whole thing as
Mhm.
well. So that was just because of the fear in the market.
Mm-hmm. Yep.
Okay.
Correct.
There was no other correlation or relationship.
No.
In terms of the technology or the
No.
protocols.
No. In terms of Bitcoin works fine. Like, it's just doing what it
It's
does.
just that people are.
Yeah, people are
they
scared,
need
and
confidence. You said that Tom Brady had.
yeah. Tom Brady had a
lost his fortune.
Yes, Tom Brady had a partnership with FTX. So pretty much anytime an exchange like this basically defaults, you can assume that any customer that had money in there is not getting their money back ever. And this is why they're under investigation by the SEC now. But yeah, Tom Brady had a partnership where he staked $650 million of money into FTT, I believe, or just inside of FTX. And yeah, all of that is likely gone unless he did pull some of it out. Yeah, yeah, he's had a tough time. Yeah, $650 million. 650. Yep. Yeah, but now Sam, the founder of FTX, did tweet out on Monday? Yeah, Monday, that nobody needed to worry about anything going on, that everybody's customer funds are safe, blah, blah, blah. And then he deleted the tweets Tuesday. But people have screenshots of them, and there's been no word from him since all of this has happened. So, yeah. It's a crazy time because, I mean, it literally, everything that happened this week is pretty much said to be the most dramatic thing that's ever happened in the crypto space. Like, and I mean, I believe it. I mean, everything that did happen, Binance CEO, CZ, like I said, he played a master game of chess. Like, he really knew what he was doing. But anyway.
How do you see that as affecting the future of people being interested in getting into Bitcoin?
Oh yeah, I mean, I believe all exchanges will fail at some point, personally. I don't really care for them. It's just in terms of adoption, I wouldn't say it hinders it too much. Mainly because the people that use these exchanges are mainly just trying to make money. They're not really using it to adopt any technology. They're just going on there to try and make money. But overall, over time, I believe, realistically, these are like the crypto exchanges. I'm not talking just a specific Bitcoin exchange, right? A Bitcoin exchange, such as Cash App, they only allow you to buy Bitcoin for any cryptocurrency, but they're not, lending customer money out or anything like that with the Bitcoin on there. Now, I still don't trust Cash App to fully do that, even though I like what they're doing and I like the parent company, Block, because Jack Dorsey leads it and he actually works on Bitcoin. So I just keep all my Bitcoin in my hardware wallets where I know it's safe, but and I own the keys. So yeah. Another question came in: how can a business accept Bitcoin? That is a great question. There are a few ways that a business can accept Bitcoin, and one of the probably the easiest ones, I would say. I'll just pull it up. It's called OpenNode.com. So OpenNode is a solution that allows anybody to accept Bitcoin as a business, and it even has these integrations like Shopify, Stripe apps, even Twitter. But yeah, you can accept it through something like this, and there are other ways that you can do it. I mean, it's being done across the world in South Africa, El Salvador, African countries. But yeah, it's just overall, I would say in the United States, OpenNode is a good solution because they make everything a lot easier for you as a business. But that would be one of the ways. All right. Anyway, we'll get through this presentation. Great questions. I love all of this. I mean, hey, this is why I'm presenting this today, because with everything that's happened in the past week, I was just trying to think of like, really, what should I go over? What's most important? And why do I believe that, one, Bitcoin is always going to be the winner in everything within the space? But two, why everything that is going on isn't something to necessarily fear about. For me personally, with Bitcoin dropping, I mean, sub 16K today, man, it is a fire sale. I am happy it's happening for me, but obviously people that hold Bitcoin, and I hold Bitcoin, I've lost in dollar terms of net worth a lot of money in the past week, but that's okay with me because I don't care about that. I'm not planning to sell it anytime soon either. But people that are using it as a savings technology and look at it that way over the long term, like 10 years from now, or 20, 30 years from now, really there's nothing to worry about. Now, people that are using it currently today as a payment system, buying products, such as these countries are El Salvador, South Africa, Central African Republic, Nigeria, yes, they would have to take into account this currency fluctuation. But still, overall, the thing is, I know this sucks for them, but overall, it's still better than their local currency that they have. I mean, like I said, with the Naira and Venezuela, Lebanon, all of these, the local currencies of Nigeria, Venezuela, Lebanon, and many countries around the world, Argentina, Brazil, their currency collapses before their eyes, just like that. I mean, in Venezuela alone, people sprint to the grocery stores right after they get their paycheck because all of the groceries go out. And also for them, their grocery stores are government-funded grocery stores, so they don't really have any type of free market perspective in that. But overall, yeah, it's just they know that tomorrow the value of their local currency is not guaranteed anything. It could lose 10% in the next day. And so for them, something like Bitcoin dropping maybe 20% in, a year or a month isn't too bad for them. Now, obviously, Bitcoin's dropped in a year a lot more than that, but for them, it's still better than the local currency. So that would be my spiel on that. But so today we're going to be going over mostly an article, and I don't think it's too long. I can read through it pretty quick, but we're going to be going over an article by Jeff Booth. Jeff Booth is he's a capitalist entrepreneur, Canadian, and he overall is a really cool guy in this space. He's written some awesome articles, and his book, The Price of Tomorrow, is a highly, highly recommended read. It's really not about Bitcoin at all. It's just talking about a deflationary future in terms of technology, and trying to wrap our minds around that worldview that technology is very deflationary in many respects, because in relation to something like photos back in 1990s, it was predicted that the entire internet storage would be gone within just a few years when photos were able to be sent in emails, because the storage for that had to be very fast. But because technology is deflationary, technology normally gets cheaper a lot over time because it becomes more efficient, outdating previous technology. And overall, in this article today, Finding Signal in a Noisy World, I thought it was very fitting for the noisy things happening in not only just the crypto space, but also just the general political environment, economic environment of the entire world today. So I'll be reading this article mostly, but also giving my own commentary on some of the things. So he starts with, in any new and developing space, there is bound to be a lot of noise. New solutions both compete for a new market against existing monopolies who currently own the market, and against other technologies try to displace them. Now, starting with technologies that are hard to understand, this is especially true in those breakthrough or innovation discoveries that change our world and force us to use a new lens to understand it. Prior biases make us less likely to investigate the new innovations on a first principle basis. Data is a legacy of our existing models, not the new ones. New ones need to be changed to predict what will happen instead of forecasted using historical data. We simplify the models in our brains for future reference to save time, and as a result, most people fall into the trap of predicting their future behavior by looking back at the past. It is why when using a BlackBerry phone, when the iPhone was released, we could not predict exactly how the iPhone would change our minds. And our minds continue to change because of the new value created, and this changed the entire industry. We move instantly when given something of greater value, and it's impossible to predict that move before we've ever actually seen it. And this is also why Kodak was destroyed by the very digital camera that Kodak created. And Blockbuster failed to see the threat of Netflix until it was way too late. And it's the same reason why all monopolies fail when misunderstanding the value creation delivered to society by new technology. Technology adoption is most often a bottom-up approach versus a top-down approach. And the reason why is simply because the people furthest away from the monopolies' power have the most to gain, and the people closest to the monopoly have the most to lose. Then, upon that, there's also always far larger numbers of people farther away from the monopoly than close to it, and it becomes easy to see how fast something that creates more value for those people can take hold and get stronger, rendering a monopoly impotent in fighting it. And he notes, this framework is important to consider regardless of whether the monopoly is an industry or whether it applies to money itself. So then he moves on to the harder to understand technology. It is even harder to understand general purpose technologies like artificial intelligence. And personally, I will say that this is completely true because AI is a complex technology. And it affects all industries, or it can predict their rate of progress. Because these general purpose technologies apply to most value creation over time, we can easily underestimate the corresponding impact on every business and in turn our own lives. For example, pretending that a narrow or general artificial intelligence won't negatively impact our job one day is something we want to believe, which ensures that narratives that support that line of thinking become popular, even if they're untrue. Then he moves on to the hardest to understand technologies. The innovations that are the hardest of all to understand are open, decentralized, protocol-level technologies. These protocols create value in the form of a new foundation that emerges slowly and methodically. Protocols are built in layers, which means we can't generally see what is possible on the next layer until it is already built. The base layer technology, protocol layer 1, that allowed computers to be networked together is called TCP/IP, Transmission Control Protocol, and the Internet Protocol. And this was developed by DARPA in the late 1960s. It wasn't until 1989, roughly 29 years later from 1960, that Tim Berners-Lee invented the Hypertext Transfer Protocol, HTTP, on layer 4, which would link those computers and web pages and would form the World Wide Web. This is why if you tried to explain the TCP/IP open protocol that allowed previously isolated computers to talk to each other, or even HTTP to someone in the early 1990s, or tried to tell them that one day that same technology, largely unchanged, would give rise to the iPhone, Google, Zoom, Amazon, and everything else we take for granted today, their eyes would roll over in disbelief. We experience value through products and services that give us value instead of trying to understand the intricate details of the plumbing that gives rise to those products and services. He says, I am going to attempt to use a framework for considering how this applies to Bitcoin and the predictable rise of altcoins, decentralized finance, Web3, metaverse, and the entire blockchain space. But before we go there, we must start at a higher level because the higher level abstraction affects and amplifies everything else. We must start at money. We must start there for the same reason stated above, namely, we experience value through products and services that give us value instead of trying to understand the intricate details of the plumbing that gives rise to the products and services, and money is the foundation layer that gives rise to everything else. Therefore, when money breaks down, standing your ground when the ground gives way will provide little in the way of safety. So, overall, money is just information. This might be hard to see because money is important information, but we don't desire more pieces of paper or the digital unit it represents. We desire the feeling we get from having those pieces of paper and what it can buy us. Regardless of whether that buy feeling is a feeling of safety, a legacy in the form of giving to your children, a vacation, status, a home, or freedom. Money is just the information, a ledger that allows us to measure what we have and what it will take in our own minds to achieve our desired result. Fear, greed, and the human desire to want more comes on top of that ledger in comparison to other people. It makes logical sense then that, number one, if money is just information, and two, money is being manipulated by central banks at an unprecedented rate to avoid a credit collapse of the system, they just continually kick the can down the road, then three, misinformation must be growing throughout the system, and I believe probably in the past decade we've seen a lot of misinformation campaigns in many regards, not just politics, but overall it's just the world of misinformation has grown a ton. But a second order derivative of that misinformation is that trust must be declining throughout the system. And I thought it was very interesting paying attention to some of the election talk yesterday, not going into any type of politics here, but just how a lot of people, what they were talking about from different news outlets were speaking of just how trust overall in America for, say, even democracy was like a threat. And I just found that very interesting. And especially as I read this article and as we're going through it right now. He continues on, but overall, today, this is the unfortunate system we live in, and it has vastly negative consequences. Because we measure a system from within the system for most of the population, it would make the truth virtually impossible to see. Similarly, every company, organization, and political party is made up of similar people measuring the system from the system, while every member of our society, writ large, believes that they can see through this misinformation better than others. So we obviously can tell a lot of times, especially politics, like it's like, oh yeah, this data, this information is going to predict this model, but we can never know until the actual result happens. And then two, especially with economics, I mean, we have many different outlets of financial information that comes flooding in for us users and consumers to actually take in. However, it's so much, and it's so much from either side. There's people right now that are saying we're not entering a recession. There's people saying we're already in a recession. There's people saying we're going into a depression. And it's just, it's like, what's the truth, right? And for us, that's very hard to see because it's become so complex and abstracted away from us that we really can't discern that information for ourselves unless we take a lot of time to figure that out. And it's funny because he also says in this article, says, caveat emptor. Although I do my personal best to go deeper on issues to understand both sides and where I might be wrong, this also includes me, a person saying that they can see through the misinformation better than others, but also the words on this page. And I believe that as I speak to you as well. I mean, there's no doubt that I can just firmly predict something will happen in the future, but I can best discern based on data that we have and data that we know that something like at least our credit system and our financial system is going to collapse at some point, but we just don't know exactly when. So by consequence, it is completely logical to see conspiracy theories, confusion, polarization, in-group, out-group bias, and social chaos reign. That misinformation in the form of money wouldn't just create polarization because money connects value between people and nations. It would drive a tremendous misallocation of capital and resources as individual actors in the system all made the system worse with their actions to make enough money to also escape the system. Chasing even higher returns, it wouldn't only be the general public. Even pension plans, which need certain growth returns to stay solvent, to pay liabilities in the form of retirement benefits, would search for the higher real returns. All of them, and us too, searching for ways to solve a growth problem to escape the very system creating the problem. And I found this very interesting. As I read this, I was thinking through the announcement of Social Security rise this upcoming year of, what was it, around 9% or something. And for me, I'm like, well, I don't even think I'm going to have Social Security when I'm 65. But unfortunately, I have to pay into it. But, you know, for the people to even keep up with inflation numbers today, like our government then has to figure out how to come up with the capital to, one, increase Social Security by 9% as their liability in that, but two, realistically, they're just printing that money out of thin air. But yes, question?
First of all, just a tutorial by the way, when I was 45,
Sure.
I thought Social Security wouldn't exist when I was 65.
Well, there you go.
We all go through that.
Yeah.
Sure, right.
That's true.
Did I hear you link, you said, so money is going to collapse at some time. Did I hear you link that to just being a conspiracy theory?
Could be. I didn't say that was. I was saying that from
Is that what Jeff Booth is doing?
yes, from misinformation we get conspiracy theories. Yeah. Now, in terms of the credit collapse, I mean, I don't think that's a conspiracy theory. That's, I mean, even our own government is admitting that we're going to fall into at least our interest expense and the debt that we're going to owe for everything that we take out is ultimately unpayable. But I mean, they're just like, yeah, it's fine. It'll keep working. But overall, at some point, it's going to collapse. It has to. By consequence of one, I believe we can look at nations like Venezuela, Lebanon, Nigeria, all these countries that have hyperinflated over the years. Currently, right now, I believe the United States is hitting more of a, not hyperinflation, but it's possible eventually. But we're entering much more of stagflation, where overall it's going to be probably, I mean, of course, it depends what the Federal Reserve tries to do, but I mean, overall, this next economic period of probably the next decade is going to be one of our worst, I believe, and possibly worse than 2008, 1929, 1930s, but I don't know. I mean, I'm just going based off of what I can see myself, but like I said, it also is determined on what the people above us do. So, yes, question.
What were you reading from?
I'm reading from an article called Finding a Signal in a Noisy World.
And who wrote that?
Jeff Booth.
Oh, okay.
Yep. And I think we're only like halfway through. So, where did I leave off at? Okay, yeah. In a world, sorry, but just side tangents, you know. In a world that looked like this, it would be easy to fall into a trap of pyramids and get-rich-quick schemes to escape, especially this rising inflation. In fact, the very structure of manipulating money, information, and corresponding incentive structure would ensure a market grew to abuse it, both in crypto and the overall market. Everyone measuring and trying to create value from the system would unknowingly contribute to greater insecurity. No one would be exempt, all searching for a higher return to escape the existing debasement of currencies crowded into markets that in turn hurt others. With this, number one, misinformation as a backdrop. Number two, a new protocol layer technology emerging. Remember that open protocols provide the most value to society and are the hardest to understand. It would be extraordinarily difficult to see why Bitcoin alone stands out as a breakthrough technology and where it is heading. By extension, it would be relatively easy in an environment for ill-informed or bad actors to conflate Bitcoin with crypto, Web3, DeFi, blockchain, metaverse, and other naming conventions to gain an advantage for their offering. A public market that, number one, believed that these were similar and watching a meteoric rise in Bitcoin over the last 13 years, while they were concurrently losing purchasing power in their own currencies, and number two, lacking the time to do deep research, would be easy targets for copycats, fraudsters, or even well-intentioned actors who might be misinformed promoting the next big thing. And I believe that we can see that something like FTX this week was probably in that latter category. Well-intentioned person, likely, trying to create awesome technology for people, but overall was misinformed, trying to promote the next big thing. This would act to amplify the cycles of highs and lows in Bitcoin and obfuscate its true nature. Firstly, by bringing more leverage, hypothecation, and rehypothecation into the overall space by leveraging Bitcoin, which has no counterparty risk, as a pristine bearer asset and amplifying the price of Bitcoin on the way up. And secondly, as each of the altcoins and DeFi schemes tied to them then fell due to that same leverage, create bank runs that would amplify Bitcoin's fall in price in USD terms, as the pristine bearer asset, Bitcoin, was sold into a failing market to cover losses, which is exactly what we saw this week. As the vastly bigger market of money broke down, the world balance sheet is approximately 4 orders of magnitude larger than Bitcoin's market cap today, and the Federal Reserve and other central banks eased or tightened in fiat terms. It would only amplify the entire process described here and create additional confusion. With that as a backdrop, I will provide a simple framework to explain why Bitcoin is without equal in its design, so others can use that framework to decide for themselves. I hope that by understanding the necessary trade-offs required in the design of any blockchain, the general public and/or policymakers can more accurately understand the trade-offs and see the signal through the noise. In doing so, I'll also show why the rise of competing blockchains and altcoins are predictable, the advantages and disadvantages, and why, in my opinion, and including my own opinion, each will fail in the end. So each other blockchain project will fail in the end.
And then Bitcoin will stand alone.
Correct, yes. And it mainly comes down to this, the blockchain trilemma. So there is a problem with technology overall, but something like this technology especially, where we have this trilemma of you can never have all 3 of these things. You can have 2 of them in the layer 1 technology, but you can never have all 3 in the layer 1 technology, okay? And the reason I say that is because something like the internet is likely decentralized, and more so it's become centralized, but decentralized and scalable in the beginning. I wouldn't say it was so much secure, but overall it's become more so taking away decentralization from big tech companies to a scalable and pseudo-secure platform. And it's tried to achieve all 3 of these things, but also in its base layer, everything built on the internet itself did not have all 3 things. So we move on to decentralization, security, and scalability, and I'll explain each of these more in depth. So Bitcoin on layer 1 itself solved decentralization and security. And there has never in history has there been a technology that has solved these 2 things together, decentralization and security. 13 years after its discovery/invention by Satoshi Nakamoto, and no matter the amount of nation-state economic challenge or fear, uncertainty, or doubt thrown at it, it remains decentralized and completely secure. This is a bigger deal than it seems at first glance, because society throughout time could never rely on decentralization and security together. They needed to rely on trust in institutions and the rule of law to keep those institutions in check for protection. The Magna Carta, Declaration of Independence, and many other such frameworks over time enshrined rights to citizens from unchecked power over them by their rulers. The problem is that over a longer time horizon, money surpasses laws, so laws alone cannot solve trust. Laws change over time, ensuring those with access to money either rewrite the laws or prevail in court. A reflection of the world we live in shows this unfortunate truth. So be it where money is most broken, rule of law breaks down. The rule of law doesn't protect citizens from the manipulation of money. It protects those closest to the manipulation. Bitcoin remains decentralized and secure because of its design. 2 critical design elements led to this outcome. Number 1, a limited block size. So we just talked about how Bitcoin blocks have a theoretical maximum of 4 megabytes. Generally, it averages under 2, but this is set in stone. This does not change, and neither it will not change based on the entire community of Bitcoin voting for that not to change. Number 2, using energy to secure the network through proof of work. Additional elements of design connected to these 2 design elements remain critical to the security and decentralization of the network. For the reader who wants to go deeper, these will be explored later in the post, and then he provides links at the end for this. But ultimately, it is important to remember that Bitcoin is open source. What we talked about at the beginning of the presentation. It's an open protocol, which means it is open to everyone to audit or use freely, controlled by no one, and freely available for anyone to change through a fork to try to design in a different way that creates more value for users. By designing that technology in such a way, Bitcoin over the last 13 years became an excellent store of value. Even though it's dropping a lot of money, for those that have invested in it over time, it has been a good store of value. But also, it's remained largely unviable to be used as a currency or broader technology stack due to its lack of transaction speed at 5 to 7 transactions per second. So this is something I haven't really talked about yet, but I'll go into this more. On the first layer, the transaction speed wasn't the only limitation. So Bitcoin solved decentralization and security, but not scalability. Bitcoin left an opening, though, because of its block size, small enough to keep decentralized. Bitcoin left this opening for competing blockchains / altcoins to do more on layer 1. So venture capital, entrepreneurs, and developers raced into this ecosystem because, number one, inventing a new coin that could compete with Bitcoin would achieve massive short-term profits for its founders and venture capital backers. And number two, with a larger block size and more permissive blockchain, more could be done. These competing blockchains would give rise to smart contracts, NFTs, and decentralized finance. It would be easy to show Bitcoin as old technology instead of a protocol layer to an audience looking for scalability and other use cases. That same choice, though, either transaction speed or providing more capability through smart contracts on layer 1, required those blockchains to sacrifice either decentralization or security to achieve their objectives. You will see from a long history of competing blockchains that they all either become centralized through a council or a smaller number of people / nodes who make decisions for everybody, or become vulnerable to hacks / outages as they scale. Bitcoin stands alone in decentralization and security. Why? Because there's simply no way around the 2 of 3 choice for a blockchain on layer 1. No blockchain can have all 3 in layer 1. The logical conclusion, though, is that if one sacrifices security for scalability, the blockchain fails because it's insecure, or if one sacrifices decentralization for scalability, a blockchain must eventually become useless for economic reasons. And while you may argue that point of view from an ecosystem that seems to provide value for a window of time, the economic trade-offs of running a blockchain that is centralized ensures it cannot work in the long term. Stated simply, if centralization is a requirement of the design, a database itself is a much less costly solution. So blockchain is very expensive in that case. In terms of economics and energy usage for blockchains, a blockchain is worse in terms of economic and energy usage compared to a database in terms of cost by those 2 terms. That economic reason alone negates any long-term benefit apart from initial holders of tokens of a centralized blockchain for the participants of the system, because somebody in the end needs to pay for it. This ensures that all projects built on top of these alternative blockchains, Web3, Metaverse, NFTs, etc., regardless of the intent of the founders of these projects, they all must suffer the same fate as the underlying blockchain. Building on top of quicksand is not a good long-term strategy. So some quick questions to bring clarity on. Number 1, how could decentralized finance occur on a centrally controlled blockchain? Well, I don't think it's really possible, right? Number 2, How would Web3's promise be any different than today's monopoly power in technology if it was built on a base layer that was more costly and controlled by very few? Okay. So Web3's promise, realistically, they say they're decentralized and they're providing people value. Number 3, what is the long-term value of a digital copy, NFT, of something connected to a blockchain that fails? A great example of this today would be Solana. Solana has become a pretty prominent NFT platform. And we know with the NFT platform, kind of recently, it's just mainly been this trading scheme of trading pictures online. I don't know why, but it is what it is. Overall, we've seen pretty much every NFT that has been worth something in 1 year completely devalue to nothing. So, basing it on a blockchain that fails, ultimately Solana has lost, I think, 40% of its value in the past day. Yeah. And Solana itself is pretty centralized. And then if we apply this to Ethereum, which also provides NFTs, Ethereum has thousands of blockchains built on top of it. So if Ethereum fails, then thousands of other blockchains fail. So just something to be very aware of. And then I think these last two questions hint on that a little bit. If a lower cost through layer 2 and 3 and decentralized alternative existed that enabled gaming and virtual reality companies to control their own destiny rather than risk their future on a centrally controlled blockchain, what would these entrepreneurs choose? Wouldn't it be more likely that this new protocol, instead of a centrally controlled one, formed the foundation of the metaverse? Right? So these are all kind of key questions that I wanted to bring some clarity on and just for us to question. So what is the vulnerability of blockchain? So all the while, entrepreneurs building to those blockchains, the general public and regulators may be unaware of the long-term nature of the vulnerability. Worse still, capital and large holders of the various altcoin schemes could become willing or unwilling participants in a perverse incentive scheme where they get rich or get out just in time at the unknowing public's expense. Charlie Munger's famous quote, "Show me an incentive and I'll show you an outcome," applies well here. If invested capital by VCs and time by an entrepreneur or team has gone into designing one of these blockchains or building a company on top of one, human nature tells us that it is much easier to obfuscate the truth, to sell to a higher bidder before it collapses than to admit a wrong strategy. As always, follow the money. The line becomes particularly skewed by exchanges who offer these coins to an unknowing public. By offering a multitude of securities, and this is the definition of securities by the SEC, altcoins 20,000 and counting that all eventually suffer a similar fate, they create enormous wealth at society's expense. And this is why governments, agencies like the CFTC and the SEC have tried to get pretty involved with this space because they're trying to protect, or at least SEC, from a securities point of view, is trying to protect the consumer. So they make transaction fees on the way in and out. Every time someone trades any one of these 20,000 plus coins, they get benefit from these fees. A very low risk business enabled by a highly susceptible public. That same wealth is then used to advocate/lobby governments for favorable policies to allow them to operate, seeing opportunities for investment and jobs from the largest exchanges while believing that Bitcoin and altcoins are similar in nature ensures policymakers are easily swayed. Much of this adds to the public and media being completely misinformed about Bitcoin and proof of work. Why? Because conflating Bitcoin, blockchain, and altcoins is key to operating profits. Okay, so we come back to this trilemma, and we're going to break down each of these. Okay, so let's start with security. Through proof of work, Bitcoin offers miners, the machines that mine Bitcoin, a way to compete to solve cryptographic hash puzzles to verify new transactions on the blockchain. Miners purchase the latest hardware to compete for Bitcoin in the form of block rewards. The reward follows a halving schedule where reward for solving the hash puzzle is programmatically reduced every 210,000 blocks, roughly every 4 years. So we know, we've gone over this, I believe, in the last lecture, but starting in 2009 at 50 Bitcoin per verified new transaction on the blockchain, approximately every 10 minutes, to 25 Bitcoin in reward in 2013, 12.5 in 2016, and today 6.25. And we can predictably say that in 2024, likely late March, it will drop to 3.125. Okay? And then this value reduced all the way until the year 2140. In the natural competition that arises in the free market with other economic actors trying to win Bitcoin, an incentive is created where miners win Bitcoin by securing the network, because the primary costs of mining are, number one, the hardware required to solve this hash puzzle, and two, the intensive energy costs to run the hardware. Miners are incentivized through competition to gain an advantage over other miners, which adds hash rate to the network. Hash rate is the total computational power for securing the network. Satoshi developed a novel way to protect the network and take advantage of game theory as the network ebbed and flowed, with the latest hardware improvements allowing faster computing and new nodes being added or removed from the network. This is called the difficulty adjustment. The network automatically adjusts the difficulty every 2016 blocks based on the time it took to mine the last 2016 blocks to keep the average time for finding blocks around 10 minutes. This takes advantage of greed and fear in a free market of economic actors working in their own best interest for gain to constantly balance and protect the network. As more computing power is added to the network, the difficulty adjustment automatically makes it harder to find the next 2016 blocks. And conversely, as computing power is removed, the difficulty automatically adjusts to make it easier to find the next 2016 blocks. This process creates more and less profitable mining operations, which take advantage of the free market. For an example, when China instituted a ban on all Bitcoin in May of 2021, the Bitcoin hash rate fell over a 2-month period, and it roughly, I believe it was pretty much 50% of the hash rate was dropped or actually it was more than that. It dropped from 185 million terahashes per second to 58 million terahashes per second. So way more than 50%. It was more like 80. But every 2 weeks, difficulty adjusted downwards to keep the average block time around 10 minutes, with fewer miners competing for rewards. And a glut of newly available mining equipment on the market hitting the market, creating downwards pricing pressure on the equipment, mining became much more profitable again. In turn, many U.S. companies rushed in to fill the void and the economic opportunity that China created. A gold rush for Bitcoin mining ensued. As more economic actors rushed in to take advantage of easy profits and the difficulty adjustment clocked higher, profits rationalized once again. And so, regardless of a nation-state attack or a boom-bust cycle driven by greed and fear, the network globally is always protected through the difficulty adjustment in creating a natural incentive to win a larger share of the economic prize. As more market entrances race in to take advantage of a higher profit opportunity created by an easier difficulty rate, they add additional security to the network, in turn taking the difficulty rate higher and their profits lower. And from a 185 terahash per second 185 million terahashes per second, all the way down to 58 million terahashes per second. We now are currently at about 240 million terahashes per second. So the network has gone down and gone completely back up, even in a complete bear market. Additionally, The process of paying for additional equipment, which is then obsoleted over time as new equipment becomes superior, is costly. This has the effect of supporting new entrants and ideas in the market. In other words, its very nature reduces the monopolistic tendencies of a market to consolidate around a few large miners and price others out. So as Bitcoin's price is dropping right now, miners, it's very likely that a lot of miner companies are about to go default. So what is that going to do? One, it's going to drop the hash rate. Two, a lot of that mining equipment is going to be sold on the market to people like us that don't have the means of buying hundreds of Bitcoin miners, but maybe you could buy one. And it also drops the price because of supply and demand. So the boom and bust cycles of Bitcoin mining should be looked at as a free market competition for an advantage in a perfectly transparent market with each rational actor, in their own minds trying to find an advantage which leads to energy innovation, all the while securing the network as a byproduct of this natural competition. So let's move on to energy. And I just want to go ahead and give you some statistics. Okay. So number one, first is an article, which this has not only been repeated by many across the globe, but in 2017, 2015, I believe as well, the World Economic Forum put out that basically, Bitcoin mining would take up all the world's energy by the year 2020. And this is one of those headlines. And this was published December 11th, 2017. And this looks like it's likely a Ars Technica, I think an Ars Technica article by Anthony Cuthbertson, if that's how you say it. But obviously that's not the case. We're in 2022 and Bitcoin has not done that. In fact, it has only taken up 0.16% of the world's energy. And this is included by data by BP and every mining company and data that we publicly are able to access. Okay, so the energy worldwide is 165,317 terawatt hashes, or terawatt hours, sorry. Terawatt hours, and then Bitcoin itself only takes up 266 terawatt hours per year. And moving on to carbon emissions, Bitcoin mining only takes up 0.1% of carbon emissions that are secreted globally. And I think that this is an important metric to understand because Bitcoin mining overall is used in many different ways that people don't really realize. Number one, we went over the global energy and carbon emissions, but two, Bitcoin mining hash rate is up 73% year to year. So we talked about how it went up from 58 million terahashes per second to now it's 240 million terahashes per second. But the energy usage is only up 41% due to an increase in efficiency of the chips that actually mine it by 23%. Bitcoin is also the industry leader in sustainability with a 59.4% sustainable energy mix. Okay, so a lot of Bitcoin farms, they use renewable energy sources, and there's a reason to this. And then ultimately, Bitcoin is the most secure crypto network, 100 times more powerful than all competing networks combined in proof of work. So in terms of just global Bitcoin mining versus other industries, residential buildings obviously takes up a lot of power, road vehicles takes up a lot of power, and all these other things. And I only show that, I don't show this really to like say, oh, but your dryers are actually worse or anything. It's just overall, understand, let's put this into perspective, Bitcoin mining is not as bad as it actually seems from a real energy use. And there's a few reasons to this. First thing here is that due to Moore's law and transistors in chips becoming exponentially better, we can see that the ARM Cortex-A9 in January 3rd, 2009, it was 877,000 joules per terahash, okay? And then we go down this joules per terahash over time has only become much more efficient, right? And today we're now down to below 21.5. And I think this is an important metric to understand, is that energy efficiency of these chips has become exponentially better. Over time, I mean, we can see that obviously from this perspective, but that's what these headlines and these people don't take into account of why they claim Bitcoin will use up all world's energy by a certain year, right? In 2017, they were basing it basically on this joules per terahash, 97, and then multiplying that number by however many thousands of miners there were in the world. However, we've decreased that number by 5 times the amount, right? So pretty much, I mean, that's kind of the reality of just energy efficiency and computer manufacturing, is that computers, no matter what, they will get better over time, just based on at least Moore's law. Now, energy overall as part of security, we need to take this into account for a few reasons. So while many people do falsely believe that Bitcoin and the way it uses proof of work to validate blocks is bad for the planet because of the energy used by the network, the truth is that Bitcoin is the only thing that we have really found that allows a transition to a system of planetary alignment and abundance in energy. As Jeff Booth has stated, abundance in money creates scarcity everywhere else, and scarcity in money creates abundance. So I like Michael Saylor's explanation of energy and money in this. When you tie energy to money, you have a stable currency, but as soon as you get rid of the energy, that money just becomes a coupon. And the reason that is because if money is detached from energy, we're seeing this right now with Russia. Russia is I believe the world's major global exporter besides OPEC nations in oil. And because the United States has detached money from energy, we've seen oil price go up a ton since the 1970s, but overall, Putin's done with it. He's tired of the United States being able to leverage their printing to buy his oil because he's not getting a benefit out of this, right? His money itself is collapsing and debasing according to the US dollar, and then overall the United States can just leverage their money printing to buy oil at a specific price without the effect of the entire economy inflating later on. And this is why we believe that money is a coupon when it's not tied to energy. So, as explained in Jeff Booth's book, The Price of Tomorrow, a conflict needs to be resolved at a system level. Exponentially increasing efficiency driven by technological progress requires a currency that allows for deflation. Bitcoin, we get more for less work. Number 2, the existing fiat monetary system requires inflation, and consequently it needs manipulation to remain viable. We get less for more work. Because the existing system is credit-based, it cannot allow ongoing deflation without complete collapse, because the credit would be wiped out, and the credit is the system. Society would never vote to have their entire way of living collapse, which means a paradox exists where society will always eventually insist on manipulated growth for fear of the consequences of collapse. And that manipulated growth is the primary source of the problems that society is dealing with, including environmental damage. Ultimately, this is because instead of allowing prices to fall and society to gain time and freedom with increasing productivity, it presupposes that we can grow forever. And the growth itself presupposes that money can be created out of thin air to achieve it. This growth for more jobs to be able to pay the bills, to pay for higher prices, which are manipulated higher in the first place, keeps society on a hamster wheel, unable to see that it is in the system itself with its embedded growth obligation to service unrepayable debt that is responsible for all the pain. It gets worse from the existing system. Every innovation lowering price or saving time in the future must be offset with more manipulation of currency to keep the existing monetary scheme going. Energy itself provides a great example. It is not like there hasn't been an abundance of technology deployed into the exploration, production, transportation, and development of new energy sources. When you realize that the primary reason increasing demand is important too, energy prices have risen against new energy coming online and efficiency gains of existing energy sources, it is that they must rise to support the existing credit system. You also realize there is no way out of the system. And it's amazing because Bitcoin is really the first technology I've ever seen that actually, one, provides economic benefit to using like energy itself in terms of just mining a currency, but two, it helps stabilize the grid. And a great example of this is Texas. So in Texas, they have used Bitcoin mining to curtail energy spikes or energy losses based on the amount of energy usage people are using. So anytime, for an example, let's say Bitcoin does use a lot of renewable energy. Windmill farms and solar farms are not always on during the day or during the night or whatever. And due to that, as you add more renewable energy to the grid, the actual power companies that have to move this energy and figure out how to use it properly, one, their transformers and everything themselves can't handle the energy that they have, and everything that goes into the power plant or goes out of the power plant needs to be stabilized, or else you're going to blow up the system. And so we saw, I think it was, I can't remember if it was in 2020 with Texas and their whole entire cold front that came in. Bitcoin mining was not really used then. And a lot of that was still in China. However, since then, a lot of Bitcoin mining has come online, and we saw a very devastating thing to their power grid based on just one, how Texas power grid works. It's very different than the rest of the country. But two, it's been incredible to watch how Bitcoin mining has actually helped stabilize the grid in the cases where it has happened again in later 2021 and possibly early 22, where Texas itself immediately has authority to turn off Bitcoin mining farms, because Bitcoin miners, all they need to do is flip an on-off switch. That's all they need. They don't need to shut down or prepare for anything. And this is able to curtail energy like no other technology. And that's been a very positive impact for a lot of energy companies. Not only doing that, but two, preventing flaring as well. So a lot of natural gas flaring has been prevented in the past few years due to the fact that Bitcoin miners can take the energy. Because if you know how the natural gas industry works, if you can't find where to send that energy or it's not being used, well, it's got to go somewhere. It can't be stored either, so they just flare it into the atmosphere, creating more CO2 emissions. So that's been a very interesting thing to see, how it's become utilized for things like that. And also there was a great example of Pennsylvania cleaning up an entire coal waste deposit that's happening right now, where they're using this wasted coal. And I know it's burning coal still, but overall they're cleaning up the society that coal waste is around, because that coal waste is leaking into the rivers and the ponds that go into the drinking water and everything. But it would cost billions of tax dollars to be able to get rid of it, but there's Bitcoin miners that have come in a lot cheaper because they, one, get an incentive by mining Bitcoin to then clean up this coal waste. So now,
They'll be close to it.
yes, yeah. Yeah, so the last part I was going to say is decentralization is a very important thing. And we've gone over decentralization a lot. And I would continue on, but there definitely is a little bit more to go through. But one thing I do want to bring up is that it's very important to notice this, that Bitcoin is the only decentralized and secure thing, because the only other competitor that I can see, which just moved to proof of stake, where proof of stake I do not believe can work in any type of consensus algorithm, mainly due to the fact that, one, power always will trump the amount of a currency. And what I mean by that is there is practically an unlimited amount of watts in the world that we can harness. Energy from the sun for one thing, but to be able to battle censorship and keep networks secure. So Bitcoin uses energy. However, in a proof of stake system, it works just like how pretty much stocks work today. So if you invest in a company and you're the primary stakeholder in that company, you practically get to decide what happens. If you own 51% of the company, for an example, in say Ethereum's case, if you own 51% of all Ethereum, and say Ethereum doesn't fork off to create more supply, well, if you own 51% in a proof of stake system, you get to decide what happens on that network. And everyone that, because you have 51% of the stake, everyone has to follow your orders. And I think after especially the move to proof of stake, this has been a very important thing to highlight, is that we call this the merge in Ethereum's case, when it merged to proof of stake earlier this year from proof of work. They have now roughly hit 70% of every Ethereum block has to fall under OFAC compliance, which OFAC is the Office of Foreign Assets Control. It's a financial intelligence and enforcement agency in the U.S. Treasury Department. It administers and enforces economic and trade sanctions in support of U.S. national security and foreign policy objectives. Earlier this year, when they merged, there is an incentive boost if you run this MEV boost, and most Ethereum mergers or proof of stake validators have started to do this, and now 70% of all blocks fall under OFAC compliance, meaning that if your transaction does not meet this compliance, it is rejected. And that OFAC compliance changes based on what the Office of Foreign Assets Controls decide. So pretty much, in my eyes, Ethereum itself has become a centrally controlled blockchain. One, over time, I already thought that it was, but two, since it's moved, it ultimately will fail. And then, of course, scalability. This was the last thing I wanted to get to. But scalability, talking about Bitcoin's 5 to 7 transactions per second, we have been able to leverage something called the Lightning Network, where the Lightning Network can scale an unlimited amount of transactions per second. And this is a layer technology on top of Bitcoin that's not a blockchain, but a payments network, which is determined on just the more nodes we have that run Lightning, the more availability there is in paying on the network. And it's actually very insane to see, because I can send anybody right now anything on the Lightning Network, not in 10 minutes, but instantly. And it's very cool to see that. So this is an image of the Lightning Network currently. There's over, I think, 7,000 nodes, or maybe more than that, 7,000 public. But yeah, future outlook, I think over time, in conclusion, that, it's early. We're in a world where there's a lot of things that still have to happen in many regards, but I believe something like Bitcoin with Lightning and developments on top of Bitcoin will work together in ways that are not completely understood, which in result accelerates adoption. And Bitcoin is the fastest growing technology that I believe we've ever seen. From a user standpoint, it's hit over, I believe now, close to 200 million people within just 13 years, and it's much faster than the internet, at least from a decentralized technology standpoint. So Bitcoin protocol scaling in layers will provide a base layer that merges a new peer-to-peer internet and money natively within it, forming a completely secure, open to anyone, integral foundation for technology more broadly. There will be successes, failures, and learnings, but most importantly, there will be enduring value to society that comes on top of a solid foundation that is incorruptible by a small group of people, decentralized and secure by its design. The emergent system launched to the world by Satoshi in 2009 does change everything. And overall, I want to give you a special thanks for this class. I appreciate your attendance and attention to this subject, and possibly even rustling up some feathers, but I appreciate it. That's all I have. And if you ever need to contact me, you can definitely contact me. I'm available on email, my website, for any more questions. So, thank you.
Bill, have you read The Innovators?
The Innovators? I have not. I have not. I will need to read that. Who's it by?
Walter Isaacson, he's like, yeah, he's incredible author.
I know, I love his stuff. Read everything he writes.
Yeah, and he goes through the digital revolution, and it talks about how technology just
Right.
exponentially, and it would
Right.
probably give you a few more stories
Sure. Yeah.
to, validate your
Sure. Right.
technology, building on technology.
Sure.
Yeah, it's kind of the history of technology.
Yeah.
What's Alice's last name? I was sitting here trying to think of it. At the very beginning. Was it Lord Byron's daughter?
Oh, Ada Lovelace.
Ada.
Oh,
I
Ada
was thinking-
Lovelace? Yeah.
I was
Yeah.
Yeah, it
thinking
starts
Alice.
with her.
Ada
Ah,
Lovelace,
yep.
yeah.
The first computer programmer.
We owe Ada's mother a great deal of thanks, because
Yes.
every time Ada showed a proclivity for moving toward
The
poetry,
humanities.
she hated
Mhm.
her husband. Her mother enrolled her in another.
Yeah, go ahead.
class.
I know that you said that other than exchange,
The
I know you mentioned
innovators.
one way to acquire Bitcoin is to sell a service,
The
and you
history.
have to be acquiring
Yes.
Bitcoin.
Yep.
But are there other ways you can acquire actual Bitcoin without going through an exchange?
Um,
Or do you have nothing to sell?
well, you can trade with just people. So, for an example, like if you gave me cash right now, I could send you Bitcoin as a trade in that regard. Besides that, mining Bitcoin. So you have that option. Sure.
Just, we can go passion and kind of play with it.
Yeah.
Not as an investment.
I'll send you Bitcoin right now.
Okay.
I mean, if you-
Don't I need an app? Can we send
Yes.
it?
Yeah. I'll just need you to download one app. That'll be it.
Okay, I downloaded actually an app called Bitcoin.
Oh, okay.
Is that
Maybe. The app I would recommend downloading is called Moon Wallet. Right here. 1 second. Let me see. It's Moon Wallet, like this. This is probably one of the easiest Bitcoin wallets to use and download. One, because it has not only Lightning integration, but it also has just Bitcoin itself. And it is not an exchange or anything. You can't buy or sell Bitcoin on here, but you can send and receive Bitcoin. And if you need help setting that up, please, I'm available to help you.
Has China still banned Bitcoin?
Yes, they have continually banned it since like 2014, I believe.
So remind me how I'm supposed to shut this thing off.
Oh, yeah.
Over here, right?
Yeah,
Right
in
here.
class, I believe. Yes. There we go. Thank you so much. I appreciate the opportunity.
Really?
Yeah.
God, we love this. Thank you.
Thank you.
No problem. Yeah, no problem.